Hello, everyone. Don Garman here from Mirador Capital Partners, here with you again because it's been a little while since we've checked in. So we will keep it brief today and just share a couple of my personal thoughts with you. My first comment is to thank those of you who have already bought and read, much to my surprise, the book that we put out. Of course, that was written over many months last year, probably seemed more prophetic then than it does now, because the central idea of the book is that when interest rates start going up, the party's over. And I think we can now look back and say, that's pretty much how it's played out so far. The nice thing is I'm going to end this little video chat with some reasons for optimism that at least I'm starting to have some conviction in. So we'll get to that in a minute. So we're getting into the summer here, right? We're now into the second week of June. And when we have talked about the moments that we've passed through over the last couple of years, one of the themes was that these corrective phases have two components, price and time. And so the way that the last correction of this magnitude was responded to in 2018, in December of 2018, very interesting, because that was a kind of almost a 1-month event. And it was a growth scare similar to what we're having now. And the Fed's response was to take their foot off the gas then, which kind of created a V effect where the end of December was brutal. Market was down about 20%, which no one seemed to notice. I thought that was very interesting. Even a lot of our clients didn't seem to notice, and nobody really responded, because by the middle of January, we were sort of surging again back upward. And that was because the Fed was still our friend and in our corner. And then we know 2019 turned out to be a good year, and into 2020 in the pandemic. I don't need to go through it month by month, since we all lived it. But obviously that has changed meaningfully in that the Fed has decided smartly, in my opinion, that they need to remove the punch bowl and end the speculation that was going on in certain parts of the market. So we are now in a price adjustment correction downturn that is rational in the sense that when I talk about these things a lot of times, like I want to make it clear, like the price and the mechanism of pricing, it's not random, and it's not completely mysterious. It has to do with compounding and the fact that these companies, they have products and they sell them to people, and there's markets of a certain size. And if they're growing and selling more stuff, they create this engine of earnings. And so those are the sort of big, powerful forces underneath. And the price that sits on top in many ways is just kind of an emotional reflection of many, many, many things at any one point in time that overlays on top. But over longer periods of time, these things become a lot more clear to see and understand. So we are clearly in the period where price has adjusted, growth is uncertain, inflation is a new phenomenon relative to the last 45 or more years. And it's potentially the worst possible scenario, except for it's very good for the 30 trillion of dollars that we've already borrowed, because the money that we're repaying those debts back with is deflating at the inflation rate. That's a lot of word jumble, but that is basically the phenomenon. It's good for the debt we've already taken on, but bad for the people who are being negatively impacted by all of the inflation that's in the system currently. So we really are in somewhat of a precarious position. But here's the optimism that I'm going to leave you with, which is that we have marked some time from the top. The growth areas of the market really peaked February of 2021. It's getting to be somewhat of a lot of time now, and they're still in the process of correcting. We've missed most of the falling knives in that segment. But the general S&P and larger cap stocks that we tend to keep, where we have more of, they've peaked 6+ months ago. So we're marking some time, and estimates are not really coming down for 2022, which I would have expected would have been happening already. So here we are in June, second half of the year is coming. One of two things is going to happen. Either estimates are going to come down. What we know is that prices have stopped going down, whereas 4 or 5 months ago, it was just down, 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 down every day. Now it is 2 down, 1 up, 2 down, 2 up. So there's at least a shift in the momentum. And so as we, move forward, if estimates come down, then forward-looking, the setup forward-looking will be better. And if estimates do not come down, then the market's too cheap now, even with rates where they are. So we're looking forward to the fact that actually the second half of the year could set up pretty nicely. So time will tell. As I always say, it never is what's happening today. It's always what's happening next, or what could happen next, that we have to pay attention to. So I'm not unhappy with how the long view has gotten to this point in the year. Mathematically, still very much in the ballgame for what could actually be a satisfying year, although we all have to endure these days in between where there's not a ton happening, because we're in the time portion of this right now, where we had the price, now we got to work the time. And so that's what we're doing. Thanks again for those of you who read through the book. I'm told it was a fast read, which for somebody who's started hundreds of more books than I finished always makes me happy if I feel like I'm in for a fast read. Really, it is just our thoughts on kind of where we are in the wealth management business, which I think gets more complicated because of all of the powers that be making tax law more complicated, and loopholes, and taking them in and putting them in, taking them out. That's that business is changing. The investment management business, I believe, has changed for a long time, and I think it's going to be, of course, I would say this, well positioned for the type of business we've built here. And so I'll leave it on that note. Happy summer. Thank you all for everything, and we will check in with you soon. Okay, bye.